This week in economics on the 17th of January 2016. Numbers man here. We'll look at a number of countries today, specifically China and the U.S. The U.S. through the Beige Book report, that's from the Federal Reserve, and the various districts there. We'll scan the highlights of it, and we'll look at the current crisis. Well, perhaps that's not the right word, but nonetheless there have been some dire predictions, as they always are when the market goes down, but the market itself is not the primary mover of things, as you see with what has happened with China, what's happening with the so-called glut on petroleum products, and the price per barrel has declined to the high 20s, and that is to be expected. That is a purely speculative market. It's been overvalued for a very long time. Now it's coming down to, quote-unquote, as some of the economists would call, a natural rate. But nonetheless, we have markets and a psychology of markets, and many analysts and economists are still doing business in the old ways. And that is unfortunate. We do have better data sets today than ever in the history of macroeconomics. However, there are still the processes out there that have been going on for the last 50 years. And that in itself does cause problems. And when you look at commodity markets, such as petroleum, being a purely speculative type thing, even with the algorithms that are out there, there's still human intervention and a quote-unquote human psychology. Dr. Greenspan talked about it as irrational exuberance. Well, part of the problem is that patterns fall in, and these are patterns of speculation, of pure speculation. Thus, when you look at people, for instance, with China looking at its GDP, that is out, is almost, is basically 7%. I should have said almost $10 trillion. I believe it's 9.24, somewhere in that realm. We'll look at it from several standpoints. But first, we'll go to the Beige Book and look at some of the Federal Reserve districts throughout the U.S. And this is on the 4th of January. This is a report from 12 Federal Reserve districts. And in context, in Boston was described as upbeat. New York, Kansas City described economic activity in their districts as essentially flat. Atlanta, San Francisco characterized their growth in their districts as moderate. Philadelphia, Cleveland, Richmond, Chicago, St. Louis, Minneapolis, and Dallas described growth in as modest. Context outside the outlook, for future growth remain mostly positive in Boston, Philadelphia, Atlanta, Chicago, Kansas City, and Dallas. Growth of consumer spending ranged from slight to moderate in most districts, while auto sales were somewhat mixed as activity has begun to drop off from previously high levels. In some districts, reports of tourism activities were also mixed. And of course, we're in the winter season. Among the districts that reported non-financial services generally grew at a modest pace, at modest or a moderate rate of pace, although some reports from staffing services and transportation services were somewhat mixed. With the exception of motor vehicles, aerospace, and most manufacturing sectors displayed a weakening in activity. Also, a few districts reported increase in manufacturing activity, then decreasing during the latest reporting period. Several districts reported strong dollar negative impact on demand, while some noted that low energy prices had a similar effect, a mixed effect. Residential and get my pointer straight here, just a second. Residential and commercial real estate activity generally improved, as according to district reports. Strong activity tended to be cited for multifamily construction and commercial real estate. House prices and commercial retail prices also rose somewhat in most districts. Overall, most districts reported that loan demand grew, credit quality improved, or loan delinquencies fell, with credit standards changing little. Districts reported that agricultural sectors weakened overall, that's to be expected, and farm incomes were stressed. Flood and drought in various regions exacerbated the effects of already low and falling prices for farm commodities, caused in part by weak global demand. You're going to hear this echoed, particularly when we move to China. The strong dollar, unseasonably warm winter weather in much of the nation further depressed. This is where global warming coming in, energy prices, and slowed significantly segments of that sector. Now, this is something that has not been mentioned as much. Obviously, the petroleum glut, but when we get to natural gas, there also. Lawmakers continue to labor markets continue to improve, with employment increases evident in reports from 7 districts. 4 districts mentioned a sign of a labor market tightening. However, districts reported little overall change in wages and price pressures, with wages increase running from flat to moderate. This is a big problem here, while price increases tend to be minimal. Consumer spending and tourism. Most districts reported some growth in consumer spending through the holiday season, with the pace of growth typically characterized as ranging from slight to moderate, as strong in Minneapolis, New York, Richmond, Dallas. Noted their sales were sluggish or had softened. Unseasonably warm weather was blamed for dampening overall sales in Cleveland, Richmond, and Dallas. For weaker apparel sales in New York, Richmond, Chicago also noted disappointing clothing sales. That's been a similar pattern throughout the year in clothing. My take on that particular element is that people in the last previous winter seasons had stocked up on winter apparel, and of course with warming temperatures they've not really needed to quote-unquote bundle up. Just strictly anecdotal there. Richmond and Chicago also noted disappointing clothing sales. Similarly, San Francisco on the West Coast reported that apparel sales at brick-and-mortar stores had failed to meet expectations. Minneapolis noted record-breaking online sales, while Cleveland described greater optimism amongst retailers anticipating enhanced opportunities for e-commerce. E-commerce is a very interesting thing. Some of the retailers were forced to offer free shipping on orders, even say less than $35. The retailer Best Buy was doing that, but part of the problem is you can only sell so many quote-unquote large-screen TVs, and they were selling a special television, as we'd call it, that other retailers perhaps did not have. And this happens in retail, that allocation from manufacturers is mixed and a very sort of a dodgy situation, as Bob Jones and Australia would say. Auto sales continue to be positive in most reporting districts since the previous beige book, which strong report in Richmond, Atlanta, and Chicago. However, Kansas City reported that sales dropped markedly compared with last year. New York and St. Louis reported recent slowing activity. Contrasted, roughly half of the districts cited continual lower gas prices as a contributing factor for auto sales, particularly for increasing SUVs and light trucks. Tourism varied districts, Philadelphia, New York, and Kansas City. Dallas and San Francisco reported overall increase in activity, while Minneapolis and Kansas City reported mixed conditions. New York indicated for weakening mild weather negatively impact ski activity in New York. Philadelphia, Richmond, and Minneapolis, but had a positive effect on short national park visits in Philadelphia and Minneapolis districts. Richmond, Atlanta, St. Louis reported a positive hotel bookings and occupancy, while New York reported that hotel revenues were down. Very interesting there, even with the New Year celebration in Times Square. Non-financial services, overall non-financial services had growth modest to moderately since had previous beige book. Professional and technical services firms saw moderate growth in Minneapolis, Kansas City, Dallas districts. Consulting firms in the Boston reported strong demand, and a demand for server and cloud computing. This is something new in the beige book, incidentally. Computing services continued to rise in San Francisco district. Contacts in New York district reported sluggish business activity. Staffing services were somewhat mixed across reporting districts. Staffing from Philadelphia reported strong growth for temporary and permanent placements across a range of sectors, while staffing demand in Dallas district varied by location. Contacts in New York were somewhat less optimistic about the near-term outlook, while contacts in Boston, Philadelphia, St. Louis, and Kansas City continue to expect positive growth. Reports on the transportation services varied. Atlantic, Minneapolis, Dallas contacts noted a surge in e-commerce shipments. Partial companies in St. Louis reported record holiday-related demand. Richmond district reported a strong vehicle import, and Atlanta posts slight strong retail goods import year over year. However, both districts noted softening in exports. Kansas City, Cleveland noted general declines that Cleveland attributed to weakness in energy and steel sector and to the import environment. Now to manufacturing, which used to be the backbone of the country, not anymore. Manufacturing activity had been varied across districts since the last beige book period, with nearly half the districts reporting overall decline. New York, Philadelphia, Atlanta, Minneapolis, and Kansas City indicated manufacturing activity declined. However, Cleveland, very important, Cleveland, Richmond, and Chicago reported manufacturing activity grew modestly to moderate. Dallas characterized its demands as flat or increased, while San Francisco reported that activity was flat to down on balance. Boston, Philadelphia, Cleveland, Dallas, and San Francisco noted strong dollar negative impact on manufacturers' imports. Contacts in Philadelphia, San Francisco also cited weak global demand as contributing to declines. Boston, Cleveland and Dallas manufacturers reported the benefits of low energy prices on their margins, but Cleveland contacts indicated that low energy prices did not offset the impact of the strong dollar. Moreover, suppliers to the gas and oil exploration sector reported weak and somewhat deteriorating demand in Philadelphia, Cleveland, Richmond, and Chicago. Generally experienced strong demand. And Kansas City. The motor vehicle and motor vehicle parts industry generally experienced strong demand in Cleveland, Richmond, and Chicago, and announced a significant expansion in St. Louis. The aerospace industry was a bright spot for metals manufacturers in Cleveland and Chicago. In Minneapolis, an aircraft producer was expanding from a launch of a new product. Very interesting there. Contacts in Boston, Atlanta, Minneapolis, St. Louis, and Kansas City remained optimistic about the near-term outlook for manufacturing growth. Very interesting there. Expectations in Philadelphia weakened significantly since the last beige book, but remains positive, while expectations of manufacturers in Cleveland have been mixed. New York contacts were less optimistic about the new term outlook. Real estate and construction, residential real estate activity as measured in sales was generally positive in New York, Cleveland, Chicago, and St. Louis. Richmond experienced steady sales with pockets of strength. Kansas City reported declines. Prices rose slightly to modestly overall in all reporting districts, and inventories remain low in Boston, Richmond, and Minneapolis. Some parts of New York district, however, the New York City retail vacancy rate increased, and it should, because rents should be lowered in that area. Although Boston contacts expected the market to perform well in 2016, contacts in Cleveland and Kansas City expressed concern that higher interest rates may slow activity. Richmond construction activity was described as modest or moderate. Residential contract activity was described, in most districts that was moderate or modest, but was more subdued in New York, Atlanta, Dallas. Overall, multifamily continued to be strong in New York, Richmond, Minneapolis, San Francisco, and showed improvement in Chicago. Most reporting districts characterized non-residential real estate activity as modest to moderate. Boston and New York indicated little change. Rent rates rose in more than half of the districts. Reporting districts vacancy rates were mixed. Most districts reported modest or moderate growth in commercial construction. The Dallas district noted higher levels of industrial construction in Dallas-Fort Worth. Contacts in Atlanta district expect construction activity to increase slightly, while contacts in Philadelphia, St. Louis, Minneapolis, and Richmond expect overall commercial real estate activity to continue to strengthen, at least moderately. Banking and finance. Lending activities appear to have improved on net. Loan demand grew on balance in Philadelphia, St. Louis. San Francisco, Cleveland, Richmond, and Kansas City reported stable credit demand on balance, while Dallas noted some recent softening. Philadelphia reported a strong loan growth for autos, commercial real estate, and commercial and industrial deals, while residential lending was flat to down. San Francisco noted, and this would be Silicon Valley, robust growth of automobile loans, mortgage originations, Atlanta reported increase in residential mortgages. They had a lot of mortgages there that went into decline at one time. Lending and refinancing, while New York reported weak demand for household sector, but steady commercial demand. Chicago noted continual strength in the automobile lending and some slowing of loan demand from small and mid-market businesses. While other household lending was little change, the slumping energy sector was cited as a factor for lower loan demand by some contacts in Cleveland, Richmond, Atlanta. I'm amazed here we don't hear more of Dallas here. Credit conditions are generally improved in New York, Philadelphia, Richmond, and San Francisco. Cited improved credit quality. Declining delinquencies are both in all are in part of their districts. Cleveland reported no change in delinquencies. Dallas, here we finally get Dallas in this. Contacts noted increased delinquencies of loans to oil and gas companies. That sector has been on watch by many people. New York, Cleveland, Richmond, and Kansas City report little or no change in credit standards. 7 districts described some competitive conditions, including competition from non-bank online entities, whereas New York cited more narrowing of spreads in all loan categories. However, Chicago noted signs of a slight tightening credit supply. Agriculture and natural resources generally were flat to down, with few exceptions. Commodity prices for crops, livestock have remained low and have fallen since the previous reporting period. That is highlighted in Kansas City, Chicago, Dallas. Reported conditions were not proper for some producers, as farm input prices have not fallen as fast. These 3 districts cite large harvests as factors in keeping commodity prices low, while Kansas City and San Francisco reported that weak global demand and the strong dollar held down livestock exports. Droughts remain a problem in parts of San Francisco district with some producers, while heavy rains and flooding continue to impact harvests in Richmond, Atlanta, St. Louis, and the Dallas districts. Most segments of the energy struggle further as oil gas prices continue to decline. Cleveland and Kansas City reported that warmer than expected temperatures throughout much of the nation has further increased already abundant inventories of oil and gas and kept downward pressure on already low energy prices. Atlanta, Cleveland, Minneapolis, Kansas City, and Dallas report continual declines in oil and gas drilling. Several other districts noted that the affected firms continue to experience serious financial stress. Out of the Minneapolis district, of course, you would have the Balkan district of North Dakota declines, and of course, obviously in the Dallas district of Texas, there reduced in employment in Cleveland and Minneapolis. Also cited positive impacts for oil refineries. Cleveland reported that investments in pipeline construction continue unabated. Very interesting there. A coal production fell in Richmond and the St. Louis district, and iron ore fell in Minneapolis. That's because of global demand problems. We finally get to employment, wages, and prices. District labor markets continue to improve. Richmond reported modest employment increases, while Philadelphia, Chicago, Dallas reported slight to modest job growth, and Cleveland, little change there. On balance, New York, Atlanta contacts reported more hiring than layoffs. Boston and Minneapolis reported mixed examples, but both reported that firms had plans to add workers. St. Louis also reported positive hiring expectation. labor markets were described as tightening, or as tight or tightening in New York, Cleveland, Atlanta, and Minneapolis. Staffing firms in New York, Philadelphia, Richmond, and Minneapolis cite various positive signs of strong labor demand, including a demand for technical sectors in the Boston district to a broad range of sectors in Philadelphia. Hiring metrics were reported flat or mixed from staffing agencies in Cleveland, Chicago, and Dallas. Overall, wage pressures remain relatively subdued. Thus, so would be inflation, as evident by reports from Philadelphia, Atlanta, Chicago, and Dallas. Just two districts, New York and San Francisco, indicated some acceleration upward wage pressures. Cleveland, Richmond, and Dallas cited mixed reports ranging from flat to moderate. 7 districts mentioned greater wage pressures for skilled workers in a variety of industries, including construction. This is very interesting in places like Arizona, and what there, when they lost a lot of construction workers, probably would also apply to many of these depressed districts. The construction workers migrated. Thus now they do not have those people. Manufacturing, finance, professional technology, healthcare sector, however, wage pressures among low-skilled positions were almost as pervasive, with 6 districts citing pressures stemming from state minimum wage increases from labor shortages, or turnovers amongst entry-level positions in banking, retail, and hospitality. All districts reported that price pressures were mixed. Price increases were noted by service sector firms in New York, Philadelphia, San Francisco, and by retail and restaurant outlets in Richmond and Kansas City. Price inputs and finished good manufacturing tended to be stable or declining, although Richmond's manufacturing contacts reported rising prices for both. Falling energy prices cited by Richmond, Kansas City, and Dallas, and lower prices for copper, steel, and other commodities, also cited in Boston, Cleveland, Atlanta, and Chicago, were generally described as contributing to lower input costs for manufacturers. Lower prices were also credited for reducing home heating costs in Minneapolis and airfare in Dallas. 6 districts reported low or falling prices for most crops and livestock. Kansas City, a big crop district, in Chicago. Contacts included that large harvests contributed to price declines. This does a summary from those districts. As you can see, the agricultural sector in many of the districts, overproduction has been their bailiwick, so to speak, or albatross, or whatever you want to call it. And in other districts, other problems continue to be out there. And I was just looking at an old Bloomberg article here. The U.S. economy expanded. This is the beige book we just recited most of the country in the past 6 weeks. The Central Bank's economic survey, that's the beige book, is based on reports from November to early January by the regional banks. And we already cited, I won't go into that, but in December, the Fed raised interest rates for the first time since 2006, 10 years. Unemployment, of course, fell to 5%. Half of it's a recessionary high of 10%. Well, that varies from district to district. 2 districts here indicated some acceleration upward, which pressures, not very little there. Some had said that these pressures would be out here. They were not out there. And now we'll move to China. headline in the Reuters here, Chinese economy. This was reported at the opening of the new bank by China, around 7% in 2015. That was reported by Premier Lu, L-I. A little under $10 trillion was reported there. And also the Chinese government has no intentions of devaluating yuan. Consumption contributes 60% of the growth. And that was openings of the Asian Infrastructure Bank there. Was there. And from the consumer prices for December 2015, the Consumer Price Index, CPI, was up 1.6%. This is incidentally from the Chinese Statistical Bureau, and we'll put this on our show notes. The prices grew by 1.7% in cities and 1.5% in rural areas. The food prices went up 2.7%, and non-food prices increased 1.1%. The price of consumer goods went up 1.5%, and prices of services grew by 2.1% in 2015, I believe is what they're saying here. And more information here. Market price of imported means of production in the average price of food in 50 cities. And we'll go to this one while we are here looking at some of the pricing from the Bureau of Statistics in China. And this is the scale. This is market prices of imported means of production in circulation in 2015. This is December 21st to 30th there. And as to where they were, and this is broken down by various categories here. Metals and non-ferrous metals and chemical products. We won't really get into all this. Coal and such things as forest products. They actually break it down. Price overall previous period and the rate of change. They do it very differently than you'll see in the West because of the models that they use. Liquefied gas, for instance, the rate here was 5.2%. Overall change 169.9 there. Liquefied gas. I don't know why we pick liquefied gas out here, but no change in rice and wheat, and 0.1 in corn. And cotton here, these are percentage of change, 4 point, wait a minute here. Get too far off here. Was a negative 0.2. Live pigs, interesting here, 4.9% change in live pigs. And peanut oil, a staple there, a 1% change in peanut oil. So you get a little idea of what's going on here. This is the Bureau of Statistics there, the Consumer Price Index. I think we went over that at 1.6 year over year. Prices grew 1.7. Yeah, we already did that. And prices of consumer goods went up 1.5%. Prices of services grew 2.1%. Overall, consumer prices were up 1.4% over the previous year. In December, consumer price increased 0.5% month to month, of which price increased 0.5% in both cities and rural. Food prices were up 1.5%, and non-food prices about the same level. The price of consumer goods increased 0.7%, and the price of services kept at the same level. Now, they have a much more in-depth reporting cycle here. In December, food prices went up 2.7% year-over-year, affecting nearly 0.91 percentage points, increased the overall price level, of which the price of fresh vegetables went up, very important here, 11.8%, affecting 0.38% percentage increase in overall price levels. Meat, poultry, and related products were up 6.2%, affecting nearly 0.46% point increase in overall price levels. Price of pork was up by 14%, affecting nearly 0.42% increase in overall prices. Aquatic products up by 2.2%, affecting 0.7 increase there. Overall price gains up by 1.2, affecting 0.03 percentage increase in overall prices there. Eggs were down 11.1%, affecting 0.10% decrease in price levels. Fresh fruits were down 6.9%, affecting 0.16 percentage point decrease there. In December, non-food prices went up 1.1 year-over-year, while prices of tobacco and liquor, healthcare. It's interesting how they list these together. Personal articles, clothing, recreation, education, cultural articles and services, household facilities, articles and maintenance services, residential increased 3.9, 3.9, 2.5, I see. And 2 and 1 and 0.8 and 0.8, respectively. That of transportation and communication decreased to 1.3%, according to estimates of 1.6 growth in December. Carryover effects of last year's price rise was 0, while new price rise factors in this year accounted for 1.6 there. Now, month-over-month changes in prices of different categories. Fresh vegetables went up 13.7%. And let's get the highlights. Eggs increased 1.3%. And let's see. In December, non-food prices kept the same level month over month, while prices of healthcare, personal articles increased 0.2%. That of transportation, communication, recreation, cultural items, services decreased 0.2 and 0.1 respectively. And finally, we get to oh boy, and 0.1% respectively. That of tobacco, liquor, and interesting why they put these in here. Maintenance services remained at the same levels. So then they go in and actually put out these various services here. There was a breakdown chart, and we'll put this on our deal. Chinese herbal medicine and proprietary medications. You have to look at this. Kind of interested in it. My pointer gets over here. 2.7 and 3.2 and they Western medicine they separate this out. Fascinating. 2.3. And let me just get to the top of this. Oh, on average, here, year by year, there's the prices here in percentages. This is on the consumer prices. So, incidentally, they break this down into Chinese herbal and proprietary Chinese medicine. Okay. And Western medicines and medications and healthcare services. So basically 2.7 for the healthcare services, Western medicine 2.3 there, and for Chinese herbals and professional 2.7. And for the overall sector, 2% increase of there. So if we go like to clothing, 2.7 there, and clothing and the faux shoes in there. But to the liquor and etc., 1.2%, tobacco 2.3%. Actually, for liquor it dropped, not a 0.8, and that is a minus. So anyway, nonetheless, we'll put that up for your perusal here. They have aquatic products, fresh fruits, which were up 7.4. Fresh vegetables, I'm sorry. Fresh fruits actually were down 3.8 tenths. Milk and dairy products, they finally appear in here. They were down 1.1 tenth. So that'll do it for that part. I will skip that. And we've already talked about the Chinese bank. And grew by around 7% there. They show the Prime Minister in the rain. And the yuan dropped 1.75% against the dollar last week, prompting the People's Bank of China to intervene in the offshore yuan market during the past week. The drop followed a 3% devaluation that was in early August. The has the largest foreign largest foreign currency reserve in the world. That's China. Policymakers have repeatedly said they have the firepower to keep the yuan stable. Prime Minister also said that employment had expanded more than expected, and this is a new figure we get here. The country's total workforce expanded to 900 million people, including 150 million skilled workers. China's fourth quarter and full year 2000 GDP is expected, and that'll be on the 19th. So we'll have that on the next report. The Chinese government has said it aims to achieve a 6.5% annual growth for the next 5 years. A goal that many economists feel would be tough to achieve, not necessarily so. But if you look at 6.5 in contrast to many of the developing countries at 2.5 to 3% if they are very, very lucky, and that includes the U.S. We'll now go and do the numbers. We'll finally get to the BBC, and we'll see exactly where the commodity markets are, and perhaps where they plan to be in the near term. And it'll be interesting to see how they're going to handle this battle between Brent crude and West Texas in the petroleum sector out there, and a little fighting with the BBC. They've decided to change things around a bit. Incidentally, Taiwan elected its first female president. Walmart has closed, shuttered 269 stores worldwide. In Venezuela, they have finally declared an economic emergency. President Mendoza there, he'll be governing by decree. The includes tax increase, put emergency measures in place to pay for services and imports. The government, as official figures released by the Central Bank of Venezuela, that the economy has contrasted there, 4.5 in the first 9 months of 2015. Oil prices, of course, continue to fall, and that plagues the country. It has the largest known oil reserves, but the world's largest known oil reserves is Venezuela, but the huge fall in oil prices has slashed its reserves by 60%. Annual inflation in September up to September 2014. This is by the Central Bank of Venezuela at 141%. Oil exports account for as much as 95% of revenue. This is a very big problem. Said soaring inflation and basic goods shortages have been caused by political opponents. We'll put this on our Twitter feed, and now let's get back to it here. On some channels you will get our full report. On other channels you will get a more abbreviated report, but nonetheless you will get the report. Let me do a couple other things here. We always talked about Walmart. Goldman Sachs in 5.1 billion bond missale deal there. Australian bank, is sued by former traders. European car sales rise 9.2% in 2015. It is up there. That's important to report. The increase was driven by large part by incentive schemes. That's according to the Brussels-based trade or the Association of European Car Makers. Several manufacturers achieved double digits. Daimler Chrysler at 117.7%, and Fiat Chrysler at 13.6%. Volkswagen, the German manufacturer, 6.2%. And the group's market share slid from 25.5% to 24.8%. Not shabby there. Annual figures were boosted by a strong December when sales jumped 15.9% to basically 1.16 million. That's the 28th consecutive month there. The European Union members, except for Malta and 3 European Free Trade Association countries, Iceland, Norway, and Switzerland. And that's where the figures come there. Sales grew strong in Spain, 20.9%, in Italy, 15.8%, helped by government incentive schemes to encourage buyers. Sales also rose in other major markets: France 6.8%, the UK 6.3%, and Germany 5.6%. Automobile sales in the EU and wider EFTA free trade zones reached a peak of 16 million in 2007. That was before the Depression, and subsequently fell to a low of 12.3 million in 2013 and rose again in 2014. And let me just make sure here that we don't miss anything out, since we are Citibank, their profits rose as their legal costs fell. So we'll get it, and then we'll go and do the numbers. Net profits rose to 3.34 billion. That's U.S. Citigroup, as they call themselves now, and the legal and repositioning costs fell to 724 million. That was over a quarter, I'm assuming Q4. The picture at Citi echoed at J.P. Morgan, which will report on Thursday. J.P. Morgan and Company will now go to the markets. And these will be Friday unless otherwise reported here. And the BBC Global 30 at negative 80.34 are 1.11% in the negative. We'll start this by reciting the negative, and if it's positive, we'll do positive. The FTSE, all shares were down 60.28. In Amsterdam, they were down 9.81 on Friday. The DAC was down 248.93. In Paris, they were down 102.73. In Brussels, 70.81. In Madrid, 244.10. In Zurich, 198.34. In Moscow on Friday, an amazing figure here, 1,608.36 in the positive. In Johannesburg on Friday, they were down 294.82. In Bombay on Friday, they were also down 399.007. In Karachi, also down 439.53. In Lahore, they were down 45.11. In Colombo on Thursday, they were also down 108.17. In Tehran on Wednesday, 679.09 in the positive range. In Sydney on Friday, they were also down 15.60. The Nikkei was down 93.84. And in Hong Kong, Hang Seng was down 296.64. In Shanghai on Friday, they were down 106.68. In New York, they were down 390.97. The Nasdaq was down 126.59. The Mercantile was down out in the Midwest city of Chicago, 41.51. In San Pablo, they were down 930.98. And finally, in Mexico, they were down 505.005. The commodities market, the linchpin of much of the shedding, as they say here. Brent crude. Futures were down $1.63 at $29.25. Brent crude on the spot was down $1.26 at $29.50. And West Texas crude was down $1.48, or a negative 4.17 at $29.72. And you can see that the pricing here with Brent crude is a little bit above it. Is it at 72 cents Brent crude was at 25 cents. In other words, $29.25. You can see the fight is on. Nonetheless, T. Boone Pickens still jumped for joy. He remembers $15 a barrel oil, but in his $15 a barrel oil was much, much more than it is today. So we'll see how happy he is. Anyway, nonetheless, cocoa futures up $48. Coffee was down $1. Gold on the Forex was down $9.65 at $1,081.10. No haven there for people, and we'll fly on down here to the Euronext Life Futures, and cocoa was up $53 there. Robusta coffee was up $9. And, we'll throw in winter wheat down 35 cents. And the Bloomberg Commodity Index was down $1.07. Our was in a negative 1.4. And it was at 73.49. And that was on Friday at 15:50. That'll do it for us. For those in business, next week a productive one. For the consumer, from the Beige Book, you have kept your eye on the prize. And enjoy next week.